Welcome to the daily update, where I'll go over the action in the market from Monday, August 26th. Then we'll see how things look for Tuesday, August 27th. Market was slightly down. Right now, it looks like just a decline or a pullback, but there are some areas of concern, and I'll go through that as I go through the charts. We have some potentially big things happening this week. There's some geopolitical events that are starting to escalate in the Middle East. That's bumping up the price of oil. This is also probably the biggest vacation week, or at least one of them. It's almost as slow as between Christmas and New Year's, but this is the last week of August. We're going to have Labor Day coming up next week. And so volume is probably going to be below average. What we'll be watching for is if we do start to decline and see more declines, what is volume doing at that point? Because when we were really going down at the beginning of August, volume was above average. As we've been going back up, volume has been below average. So that can give us some insight as to what's happening. We're still positive in the short, intermediate, and long term. However, we're overextended to the upside, and the market appears a little bit vulnerable here, but some good information could come out. We're going to have NVIDIA with the earnings reports after the close on Wednesday, and then we're going to get core PCE on Friday. So those are a couple of catalysts that could really drive things. Okay, I do have the SPXInvesting Program. It's up, it's going, it started at the beginning of June. It's free for right now. And I was going to lock that down here in August, but due to some upcoming potential travel plans to the Middle East, no less, I've decided to delay that because I don't know if that trip's actually going to happen or not, depending on how things escalate or de-escalate. But there is a link below this video that will take you to the website itself. There are also some videos on the YouTube channel. I have a playlist there. You can go through and watch those videos. If you have any questions, if you want to contact me, here's an email address. Another thing is members get access right away to the daily video. They also get access to the weekly videos where they're delayed before they actually go public on YouTube and Rumble. Also, the daily videos, the real foundation of all the analysis that I do. All of the other videos around the outside, those are meant to supplement the daily video. Okay, let's go back and talk about what happened. The futures were looking pretty good. Europe was doing pretty good there. And so we had a higher open. And a lot of that could have been on the heels of Chair Powell's speech last Friday. That was taken as very positive. There's probably a lot of folks that looked at things over the weekend and got on their computers and decided to put in some orders. Unfortunately, we set the high right at the open. We did open up, but we went down after that. And we got about up to the 56.50 level. And then we declined down below the unchanged level and the daily pivot at 56.21. Then we initially found support at 56.10. We didn't really hit any pivot points in Monday's session, but we were dealing with round numbers here. And we were able to climb back above the daily pivot, but then we declined without reaching S1. So we didn't get to R1 on the upside or S1 on the downside, just dealing with these mental numbers and strike price numbers and so forth. Prices then attempted to rebound, but the daily pivot acted as overhead resistance, and we closed just below that. We were down 0.32% on below average volume, and it could stay low, especially if we go sideways to slightly higher. There probably will stay this below average volume that we've been seeing. We just want to watch things in case the selling really picks up with intensity. So we're still positive in the short, intermediate, and long term. Inflation and interest rates, at least for right now, the scenario seems to be more friendly about things. And then, of course, the different geopolitical events that are going on. Some comments. Oil is rising on an escalation in the Middle East. There was some back and forth, especially with Israel attacking Hezbollah in Lebanon. And so what's that going to do? It was a preemptive strike because Iran under Hezbollah has been threatening to attack the central areas of Israel. Hence why the trip is got a big question mark next to it right now. Then we have this thing called the mass index. It's one of our indicators that we follow, and it's already signaled a reversal. Now, we've been going up as this signal was doing its thing to get generated, so we'll have to see. Does that mean anything? We're seeing some areas of concern like we always do, but we don't want to take this signal isolated all by itself and just say, oh, we're going to go down from here because the mass index is saying so. We don't know that. Here's our short-term list. We're still extreme positive with the 19-day advanced decline ratio based on price. The 20-period exponential moving average on the S&P itself, CCI 20, CCI 14 is not there. The rate of change going back 10 periods, the slope oscillator, the Stochh RSI, Williams percent R, stochastics. The boom indicator has come down, but we're still kind of far away from that 20-period moving average. And this is what's causing me some concern. We've got the 20-period moving average study. It's hitting 90%. That means 90% of stocks in the S&P are above their 20-day moving average. And that can sometimes signal some kind of a top, not necessarily a reversal, at least yet, but exhaustion, or are we going to just chop sideways, or we could see a decline from that. And I'll show you the chart to back that up here. In the intermediate term, we have our 50-period exponential moving average on the S&P itself. The TTM squeeze keeps going up. The PMO studies, we have two areas out of the three that we see on that chart. The Sean trend meter, the NASDAQ 100 bullish percent index, it's coming down, but it's still extreme positive. The money flow index is extreme. And then a little bit longer term is our 10-day moving average of the new highs and new lows for the S&P 500. In the long term, we still have our 200 and 150 simple moving averages that are looking extreme. Again, you could suggest that's good momentum there. This is the scenario that was adjusted a little bit after Friday, that yes, the Fed has not cut rates yet. They've left rates unchanged. And this concern that seemed to be developing in the beginning of August seems to kind of gone away now. And that there's pretty much, as denoted by Chair Powell's speech on Friday, and then what we're seeing in the charts, that there will be a rate cut in September. We just don't know how much. The dollar was up and interest rates were also up. Just barely. We went from 3.81% after Friday with the 10-year yield to 3.82%. And the dollar bounced after it had a pretty difficult week last week. And both of these together put some pressure on stocks. We're still inverted with those yield curves. I have lots of charts that I follow with that. I go through some of them in the weekly videos, but we just keep watching this to see if we're going to go back to an uninverted or regular type of yield curve. Sentiment did tick up. We were at 53 after Friday. We're up at 54. We're still in that neutral area. We have to get above 55 to actually drift over into positive sentiment there. And we are positive with our trend. This is another concern. We do have the green line on top, but it's been going sideways. And we're not really seeing an awful lot of strength with the green line right now with the ADX. We're below the moving average, so that suggests a weakening trend, but we're still above 20. Now, the short-term ADX is starting to fall below 20, which could suggest a non-trending environment. And since we had the slight down day, the bias is negative. That's usually an up or down day in and of itself. But the momentum, when you take the last 2, 3, 4, 5 days together, has been positive. The economic reports, and it was kind of in reverse order here. We had durable goods coming out at 9.9%. That's pretty big. That was a lot more than the 4% they had expected, and way up from the minus 6.9% we saw last time. Then they break it down a little bit. They take out transportation where it was down 0.2%. They expected it to be up 0.1% as it was last time. And here is a chart looking at the year over year where it's coming back up and above zero on a year over year basis for now. And then when you take out aircraft, also going back up above zero. And then this is the month over month reading where we saw a decline before. Now we're seeing a pretty solid advance, more than what we've seen on this chart anyway. Okay, then looking at this, and I always have to break this out because this small area may be really hard to see. So I get my browser up to 500%. And get it as big as I can and then do a screenshot here. And really all this is talking about is on Friday, there was a, a real solid a number of advancing issues. And they say, this is bearish. Well, we want to keep an eye on that because sometimes when we see really strong moves in one direction or the other, it doesn't necessarily mean that things are going to stop, but it might mean that they slow down. And so here are the different signals. And then what happened after that? And when you break it down, we're up a little more than 60% 1 month out, 62.5% 3 months out, 68%. It's when you get a year out. So this is a bigger picture look at the big advancing issues that we saw on Friday that's really helping the broader market. It may not do as much in the short term, but further down the road, it tends to really help. Okay. Then this is the yield curve, and these are the forecasts that are coming out that eventually we're going to actually drop, or I should say rise, back up to the 10-year, which is here in yellow, which should be above the 2-year, which that makes logical sense. But we've been inverted now for a few years, and we're just waiting to see if that's actually going to happen. And then just looking at what money's coming in and out of the market, I usually just look at the extreme areas here. REITs, that's real estate investment trust. A lot of money going in there now as interest rates are coming down. Folks think that's more of an attractive type of an investment. And the financials are doing well, and that's encouraging, at least for the moment. What we saw back in 2007 going into 2008 and 2009, we don't really see that on the horizon at this time, but they didn't see it necessarily back then either. So that's why we want to keep an eye on things. A lot of money still going into tech. And then a lot of money now coming out of Japan, healthcare, which is more defensive, staples, which are also more defensive, and tips. These are the Treasury inflation protected securities. These are the types of instruments that folks get into when they're worried about inflation and interest rates going up. And if they're ditching those and getting into longer term bonds, that just shows that the folks that are doing this think that interest rates have topped out and will start coming down in the bigger picture. Okay, financial conditions, after really coming down, is now starting to tick back up, where we're having looser conditions right now, and that could end up helping the market. And then discretionary versus systemic strategies. I explain this really briefly here. Systemic type of approach just means you have a system and you never deviate from that. Maybe 60-40 bonds, maybe always in index funds, and you just let it ride and let it go. Where discretionary means, okay, now I'm going to time things a little bit. I might switch things from one area to another area. And as we were going down in the beginning part here, we saw a real systemic type of drop as well as the discretionary drop as the market was having some trouble. Now this has been starting to come back up a little bit here. And then fund flows into bonds and equity funds, they've actually been coming out. Folks are getting a little nervous about things right now, but it's still positive since it's above zero. And then the market implied change in the Fed funds rate, the market is pretty much anticipating that rates are going to be lower going forward. Then this is just to show you what's coming out as far as earnings in this week here. The big one is going to be NVIDIA, which will be right after the close on Wednesday. So here's a little calendar. I found this on Twitter. If you're really follow earnings, you might find this kind of useful with the company logo and all those kinds of things. And then U.S. government debt is now at a very high level. Gee, you think? Yeah, it's 100. The max was 126% of GDP, where we're usually well below this 100% level. And when we get above this kind of orange dashed line, that's when it's considered to be unsafe. Well, try to tell the politicians that. They just keep piling on more and more spending, like modern monetary theory actually works. And yes, I'm going to be doing a supplemental video on the website about that. And I try to, when I do those types of videos, I try to shoot the middle. I say, okay, here's the positive side, here's the negative side. So I don't have time to debate and argue with people. I just present the facts and let you decide what's going on here. But you can see that the debt level is pretty stinking high, and that should be a cause of concern, but for a lot of folks, it's just not. You notice the last time we were at this level, 1946, that's right when World War II ended. Okay, then inflation expectations drop, and I don't like this lowest level sense stuff, but just know overall, not only in the US, that's the light blue line, but in Europe and in the UK, we're seeing pretty much inflation going down from here. Those are the expectations anyway. That's looking the 5-year inflation swap rates. Okay, and then this is put out by Sentiment Trader. This is looking at the panic euphoria model where we had come down and we're actually looking a bit more pessimistic here. Now, this is longer term. So going forward, this suggests there's still more room to the upside. This is another sentiment gauge that can be useful more longer term. Okay, here's our intraday chart where we gapped higher and set the high right at the open. We didn't see that price again for the rest of the day. We ended up dropping down below the unchanged level. We got below the daily pivot. Now, at least initially, prices were along the daily pivot. We came down to this 56.10 level and then bounced up, got above the daily pivot. And I don't rely on this a lot. This is a moving average. Sometimes this can act as either support or resistance, and it appears that it acted as overhead resistance in Monday's session. We came back down below the daily pivot. We never got down to S1. Then we tried to go back up, but could not get back above the daily pivot, and then closed down slightly below the daily pivot. Yeah, the longest word I use to describe what's going on here, and that happened many times. Okay, here's our intraday chart. Not really seeing much of a change in the initial overnight reaction after Monday's session. This is still a concern. We're seeing the red line above the blue line. That means value is outperforming growth, and they're starting to separate a little bit more on an intraday basis. And we're seeing a little bit of weakness here, which is causing us some concern. Back when we hit this low in the early part of August with the big down day, we were seeing, for the most part, growth really outperforming value. Now we're starting to see value outperforming growth. That is a warning sign to us. End of day, growth was down where value was up for the large caps, down more with the mid caps, and down with the small caps where it was up for value for the small caps. So we're going down with the growth to value ratio with the small caps, mid caps, and the S&P. Not seeing any real leadership role here now. Looking at this growth to value measurement, we're going a little bit down even more inside of the rainbow. And we came down a little bit here with discretionary to staples. We want to see discretionary and growth really doing well in a solid environment, and we're just not seeing that right now. Large cap growth, though, was down, but still above its 50-day moving average. And the large to small cap ratio did decline. That means that small caps had a better day than large caps on Monday. But this declining, it could be a little cause for concern, but when the market really gets going to the upside, it's the large caps that lead the way. But small caps can come in and do well and have a leadership role at times too. It's just, that's not what we've been seeing over the last few years. Here's our trend. We're coming down with the ADX. We're not getting back above the moving average. The green line's on top and flat to slightly declining. The red line is going down, and that's somewhat positive here. But this suggests we have a weakening trend, but it's still a positive trend. In the short term, we're starting to drop below 20 now with the ADX. That means we're, at least on a static number measurement basis, we're going into a non-trending environment. It's still positive, though, because the green line's on top, but it's flat to slightly declining as well. So this is a little bit of a concern to us. And volume is well below average, and I've already talked about that. Sentiment, here's the weekly gauge that we look at. It's at 72.88. We're neutral with the gauges that we follow, or this is more into the positive area. And the Ulcer Index, after giving us really high readings, has really dropped down and is below its moving average. That's another sentiment gauge. We were up slightly with the VIX on a closing basis with the line chart as well as the bar chart. And the VIX of the VIX also ticked up with the line chart on the bottom and the bar chart in the middle area. But the momentum of the VIX, after really spiking up in early August, continues to be down. And this is an updated chart here for seasonality. This shows the monster down day that we saw back in early August, and then how things have come down since then. And then what will happen? Now you can see here, it's kind of interesting. The VIX should have been going down at the beginning part of August, and it spiked up to a higher level than we've seen in a long time here. So it was actually going in the opposite direction of seasonality. But what we're looking at is the overall trend. If we see more of a decline at some point, that's going to send the VIX higher. Okay, we're keeping an eye on the skew index because it's getting up into that red area. We don't know if it's positive or negative, but the market is they're expecting some kind of a big move when we look at this particular sentiment gauge. We ticked up slightly with the daily chart of the equity put call ratio. We're going up with the 5-day and still going down with the 10-day. So a bit of contradiction there. We're declining with this fear gauge, even though it ticked up just a little bit on Monday. And we also continued to decline with the other fear gauge. We're keeping an eye on the spread between risky and not as risky bonds here. This is the chart that we've been following. This continues to go up, and that would be more positive for the market. That just means there's less fear in the market currently. And we look at the risk on to risk off ratio, where it was down. Folks were more risk off in Monday's session. And we're keeping an eye also on volatility risk premium, still getting a very low reading here. Our advanced decline lines still looking pretty good. We were flat based on price, but still breaking out to a new high here. We were also flat with volume, but we have not broken out yet. So that's a bit of a negative divergence there. But we're still above the moving averages, and the moving averages are going up. So that's positive in and of itself. And internally, when we saw that bit of a gap higher on Monday, that triggered a whole lot of new highs here. And so our 5-day and our 10 days going up. So this part still looks pretty solid. And this measures the whole S&P 500, not just a few of the stocks. The advanced decline ratio, short-term blue, that's still extreme positive. We're still looking positive here with the more intermediate term in red. And we're still extreme positive with the advanced decline ratio based on price. We drop down based on volume. And this is a 10-day average of the highs minus the lows for the S&P, still looking really extreme here. That could suggest good longer-term momentum. And here's our accumulation distribution, coming down slightly, but still suggesting that we're kind of far away from the moving average, but we're still positive with this, even though it declined a little bit, and the moving average itself continues to go up. So this is positive, but it does have some warning signs. We ticked down just a little bit here with the Chaikin money flow after it had really been advancing, but the red line continues to go up. So this is positive too, but some warning signs here because it's going down now. This is more of a warning sign to me, and I picked this out over the weekend, and I'm still following this. We have been declining here with the Chaikin oscillator. We're still positive since we're above zero, but you can clearly see that we're starting to come back down with this smart money indicator. The vortex looking positive with the green line above the red line, even though the green line came down. What's causing concern here is that the red line is getting extreme negative currently. And we look at the advanced decline line on a cumulative basis for the S&P, still looking really good based on price, holding up but not breaking out yet based on volume. And we look at the S&P compared to the NYSE advanced decline line. The red line is above the S&P. Yes, they're on different scales, but this just suggests the broader market is holding up. And here's the NYSE advanced decline line. Actually ticked up and was able to get back above its moving average on the cumulative basis and continues to go up here above the moving average with our regular NYSE advanced decline line. This other advanced decline line on the NYSE is also looking pretty positive there. The common stock still going up, setting new all-time highs, and actually being confirmed here by volume. So we're not necessarily seeing a confirmation of volume in the S&P, but we are seeing it on the NYSE when we look at common stock. Our advanced decline line study still looking pretty solid here with the NYSE common stock going up a little bit flat, but still looking good with the S&P. The mid caps declined and the small caps declined, but both are still above their moving averages. Here's the short-term chart. Not an awful lot to really see here. We do have this dashed line, which is a pivot point, which may act as overhead resistance if we continue to try to go up. And that's just a little bit below the all-time high here. And we're not too far from that all-time high, but we're still above the 50-day moving average. The 50-day moving average is still above the 200-day moving average. You can see over the last week and now so far in this week, we're dropping well below average with volume. And we're looking rather extreme here when we just look at the S&P 500. The 20-period exponential moving average is extreme. Now the 50 is becoming extreme. The 200 is close, but not quite extreme yet. The boom indicator did decline, but is still showing we're kind of far away from that 20-period moving average. Still looking pretty good here with the 50 moving average and as well as the 200-period moving average. We're extreme with the Stochc RSI, the Williams percent R. The CCI 14 is not extreme. The CCI 20 just barely extreme right now. Stochastics are still looking extreme in the short, intermediate, and long term, and we haven't started to roll over yet with the longer term stochastic. The force index continues to be positive. And then looking at the condition of the 20-period moving average, we're still above both lines. And we're seeing here where the green line is now crossing back above the blue line and price is above both lines. So that's rather positive currently. Here is the simple and exponential moving averages based on 20 periods, still looking pretty solid here. And the rate of change going back 10 periods, it has declined slightly, but it's still above this red line. So that's a little more, it could be short term. I put it in the short term category here, but that just means that we could be in for some sideways movement, not necessarily a reversal. We're not extreme with the standard deviations chart. We're in the +2 channel. We have not come up to the +3 channel. That's where we get extreme positive. Balance of power, no longer extreme, coming down, but still positive. Here's the condition of the 50-period moving average, above both lines, and the lines are going up. So that's looking pretty good. We're above both the simple and exponential moving averages here. That's positive. All of the moving averages are still above the other, or prices above all the moving averages. The longer we stay up here, the more these lines will go back up and potentially smooth out if we remain positive. Still looking positive with the go, no go for right now. We're still dealing with the highest high value on this chart. That's positive. The TTM squeeze just keeps going up and up and up here. And to give you some more perspective, this is a pretty high reading when you compare it to other readings that we've had recently. It could still go higher than where it's at now, but this is a bit of a warning sign. Standard deviation really dropping off as the last few days. It takes 10 days together, 10 periods. And this is really dropping off as the market settled down. And we tick down, but we're still positive with the ease of movement. We're still going up here with the Erin. We're above zero with the oscillator. That's positive. And we tick down. We're no longer extreme with the S&P McClellan oscillator, but we're still looking pretty good there. And when we're above zero with the McClellan oscillator, we're going up based on price and volume. We're kind of getting up to this red line here, which sometimes can be extreme positive. But for right now, we're just treating that as positive, and we're seeing price and volume confirm each other. We tick down, but we're still positive with the NYSE McClellan oscillator. So we're going up with the summation index based on price and volume. This is a concern too. This is one of our primary indicators. Well, it's kind of right in between. It's between a primary and a secondary indicator. The Swenlin trading oscillator has been declining based on price and volume. That is a little bit of a warning sign to us. But when we look at momentum, we're still going up with the PMO. When we break it out based on price and volume, they are still positive. We're getting a little extreme here with the PMOs that are rising, starting to get extreme with the buy signals, but still continue to be positive with the PMOs above zero. We are neutral with the Elder's impulse system for the S&P. We're positive with the parabolic SAR. The slope oscillator, still positive, but above this green line, looking extreme positive. The MACD continues to be positive, so we have a short and somewhat intermediate term oscillator that continue to be positive. So here, with the short term, intermediate, and long term, we are still positive on a momentum basis. The Copic curve, another momentum oscillator, is still positive. The Sean trend meter is positive and just into that initial extreme positive area. The bullish percent index for the NYSE is still positive, above 50. We're still going up with the bullish percent index for the S&P 500. That is really pretty critical, and we were actually up in Monday's session. That just shows that the rest of the S&P is experiencing some buying, where maybe the bigger stocks are taking a bit of a breather, to put it that way. We're coming down, but still extreme with the bullish percent index for the NASDAQ 100. The money flow is extreme positive. We're declining with the ultimate oscillator, but we're still above 50. On balance volume, is still above an advancing moving average, even though it declined slightly. And when we look at the RSI short term, that's 9, and RSI 14, that's more intermediate term, we're above 50s. So even though they declined, the momentum is remaining positive now. This is what's causing me some concern. The percent of stocks in the S&P above their 20-period moving averages, we're hitting 90%. Now, we could go a little bit higher than this, and it doesn't necessarily mean a reversal, but you can see other times when we hit really, really high readings, it didn't necessarily bode well, at least in the short term, for things to continue to go up. It was more sideways. And we're getting really extreme here with our study. Anytime we get above 70 here, that's just showing good momentum on the short-term time frame. And we ticked down a little bit, but we're still positive with the 50-period moving average study. We were flat with the 100 and actually advanced with the 200. This is the mass index. The signals have been triggered now, and this tries to anticipate a reversal since we were going up that caused this signal to actually happen. We'll see if this is going to be a valid signal or not. Pring bottom fisher, even though we didn't really hit much of a bottom. I mean, it was still going down here when we had the downward move in early August, but for some reason, it's giving us a buy signal right now. And then last week, we did enter a new 50-week cycle. Again, I don't put a lot of reliance on these things because we really only know if they worked in hindsight, and that's just not good enough for the analysis that I like to do. This is still looking positive. We're above the R2 level here when we look at the weekly chart for the S&P, and we're still having a hard time breaking above the 61.8% fib extension level for the S&P. But on a trending basis, the Heiken Ashi is still positive, the Kagi chart is positive, the Renko is positive, and the 3-line break is positive. And with the upward open that we saw, we had just enough to go back and put a new X in here at 5650 on the point and figure chart. We're still working out of a double top breakout that was generated a week ago on August 19th. Long term, looking a little extreme here, but again, it could suggest good momentum with the 150 and 200 period moving average studies. We're still positive across the board with the Keller market model on all time frames and on all indexes. We're still negative with commodities and the US dollar on all time frames. Still positive with the decision point scorecard. And we saw where tech was down, a little bit of profit taking there. Energy ended up being up and staples were up. These are more defensive areas. Also utilities, which could be classified more as a defensive area. Discretionary ended up being down. We want to see that going up. And here are the alerts that were triggered. A lot of nice ones right at the open. We read this from the bottom up. Canada set an all-time high. Real estate, 2-year high. Then the dollar has been having some problems here. We have a moving average crossover. But then later in the day, it looked like things were getting a little more positive, except oil. That kind of should be taken as negative right now because it's more geopolitical, where it got back above 75 and has also had a MACD crossover. Okay, and then looking at the S&P versus the equal weight, both holding up. The red line's still above the bar chart, even though they're on different scales. Looking at the ratio, we ticked down just a little bit as the broader market or the equal weight index slightly outperformed the S&P. This is something I pointed out over the weekend, which is positive in and of itself, but also has something negative to be concerned about. This is when we break down Dow theory and actually change it. We swap out the Dow for the S&P equal weight on the top, and that's just coming off setting a new all-time high. And that's good. That's showing that the equal weight is really doing well right now. The negative divergence is we're not setting a new all-time high here with the QQQ equal weight. Instead of using the transports, we swap it out for the equal weight QQQs. And this is a little bit of a concern right now. We want to see this doing better than it has been. When we look at the new highs, new lows for the NYSE, still looking really solid here now for the NYSE, the broader market. And we look at another broad market measure and take a 5-period moving average of the highs minus the lows, still looking good here. And the Dow was up slightly, and I guess it goes in the books as a new all-time high, but there wasn't an awful lot of partying going on that I saw. And of course, I don't really watch that stuff anyway. We are positive with the diamonds when looking at the Elder's Impulse system. We did come back down and drop below this pivot point, and we're just above the 50-day moving average for the NASDAQ, where we're coming back down to the 50-period moving average and below this pivot point here with the NASDAQ 100. That's a little bit of a concern. Maybe this is some anticipation ahead of NVIDIA's earnings coming out. We continue to be neutral with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive, even though it looks like it's stalling out just a little bit. And here we're right back down to the 50-day moving average with the Qs. And just kind of bouncing around under this 38.2% extension level for the triple Qs. Small caps were down. They really haven't broken out, but haven't necessarily broken down, at least yet. And we're still looking okay with our other small cap index. We're above 50 with the RSI, above the 50-day moving average, and the momentum is still positive. And we still are positive here with the Elder's Impulse system for the small caps. And we look at a ratio between the small caps and the tech sector. It went up a little bit here as small caps had a better day than tech on Monday. The mid caps did decline, but still above this pivot point now. And they still remain positive with the Elder's Impulse system. Keeping an eye on the broad market, we declined, but we're still above the 50-day moving average with the Wilshire. And we declined 0.22% here with our total U.S. stock ETF and still well above its 50-day moving average. The financial sector was up and setting new highs here, so that's more confidence for the economy anyway. And we dropped below the 50-day moving average with the FANG index. That's a little bit of a concern. We're seeing at least some initial weakness right now with the mega caps and the big tech stocks. And we look at the staples to tech ratio, it's going back up. Staples had a better day than tech. So here is Apple. It was up 0.15%, still looking pretty solid above its 50-day moving average. We were down with Amazon in between its 50 and 200-day moving averages. Microsoft was down 0.79%, still above its 200-day moving average. Google was up 1/3% in between both of the moving averages. Meta was down over 1%, 1.3%, but still above its 50-day moving average. Here's NVIDIA down 2.25%, but still above its 50-day moving average. And Tesla was down 3.23% and dropping below its 50-day moving average. Netflix was up 0.25%, still looking pretty solid here. And the dollar ticked up just a little bit after it had been under some pressure, but we have seen a recent death cross here with the trend on the daily chart. Oil did go up. It's not into the 80s yet, but it was in the low, about the mid 70s, where it jumped up to 77 in Monday's session. And this is something just to be aware of here. I reported last week about this. Somebody had said, a few sources had said that a new ZWAG NYSE breadth thrust had been triggered. According to the chart I follow, that's not true because we never got down below this 0.4 area. And what happens is we get down here and then we zip up within 10 trading days and see an extreme positive reading. That's where you get the term breadth thrust from extreme negative to extreme positive. So we didn't see a signal, but anytime we go above this red line, that just shows that there's good breadth for the NYSE. So this should be taken as positive nonetheless. When we compare international stocks with US stocks, still seeing the short-term relationship pretty strong here, and the relationship longer term is still pretty strong. Just to look at some sectors right now where we have the staples going up, that's a little bit of a concern to us since that's a more defensive measure. Utilities also could be they typically are classified as a defensive area. They were up as well, but you can also make the case for the idea of switching to a different type of an environment could bode well for the utilities and make them more like growth stocks. Healthcare, another defensive area, was actually down a little bit, but it's still looking quite strong these days. And then energy, just keeping an eye on this mainly for the geopolitical aspects. And then we were down with the 10-year, we were up with the 10-year based on yield. We were down with the 10-year based on price. And not really seeing any improvement here with our growth to value ratios, dropping below the moving average with Qs to S&P, right on the moving average with discretionary to the S&P, and large cap growth is now dropping under the moving average when compared to large cap value. So the large caps are showing some weakness, mid caps and small caps. This is not necessarily positive for the market. We want to see these ratios going up, not down. The S&P to utilities ratio did go down just a little bit here, but still we want to see this really showing some conviction to the upside to be more positive. And the staples to S&P ratio did go back up after it had been declining. We want to see this decline to be more positive on the S&P. So what's our outlook for Tuesday? Just keep in mind that the Monday coming up, September 2nd, the market will be closed for Labor Day. It's the unofficial end of summer, and people go camping and have barbecues and kind of say goodbye to the summer. NVIDIA will report earnings after the close on Wednesday. We're still positive technically, but we're overbought on below average volume. And because of that 20-period moving average study, we want to keep an eye on that. Doesn't necessarily mean a reversal, but to see those extreme readings, that doesn't happen very often. We're going to get the the FHFA Housing Price Index, as well as the S&P Case-Shiller Home Price Index. So a lot of real estate and housing information coming out on Tuesday, as well as consumer confidence. And then all the crazy stuff going on in the world, wondering if it's going to escalate to the point of actually impacting the markets. So here is the economic calendar. Wednesday is going to be pretty light. This is a weekly report that we get. Kind of the big one will be jobless claims on Thursday. We're going to get the second estimate of GDP. Now, we've seen that number before, and it really only goes crazy if it's a lot different than the first number. The big one is going to be PCE, core PCE on Friday. So the market's kind of anticipating that. So, and then NVIDIA will come out after the close on Wednesday with their earnings. That's probably going to impact how things fall out on Thursday. Okay, here's another look at the economic calendar. Seasonality, we're neutral to negative with the Dow for August 27th, blah, 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 where we're neutral to positive with the S&P and NASDAQ. And Tuesday, when we compare it to 2023, pretty much a flip of the coin, whether it's up or down. But compared to what it's been doing thus far in 2024, it's up 14.6% of the time. And then here is a look at some potential positive seasonality here from the 27th going into the 28th. But then Stock Traders Almanac posted another chart here and matched up with where we closed on Friday with what we could see during an election year. That's the green dashed line here. Not anything all that spectacular for Tuesday's session. And then looking at the seasonal patterns from 1949 to 2023, during all election years, we tend to be more positive, but when it's an open field like it is now, that tends to be more negative, especially when we get into September. And then looking at August, this is an updated chart as well. We're ending up actually being up for the month. It's September that can cause some concerns. We also look at September here on a seasonal basis, which is often negative. And then taking August through October, I believe this chart was also updated as well, but not really good returns for the August, September, October timeframe. But we are positive in August during an election year, no matter how especially it's the most positive, but no matter how you calculate it, September ends up being negative. Just something to be aware of. And then looking at 2023 and comparing it with what's happening this year, this hasn't been updated as much. Now, it's still a few days old, but we can often see some weakness going into the latter part of September, even into October and early November, based on what happened in 2023. That's when right near the end of October is when we hit the bottom that we've still pretty much been bouncing up out of in 2023. So the warning signs, we're keeping an eye on these defensive sectors, just watching them. We're a little bit concerned about staples. Healthcare has been holding up very well. Utilities, trying to figure out, is that a growth play or a defensive play? And then energy, more for geopolitical reasons. The 5-day equity put call chart is still going up, and growth to value as well as discretionary to staples, they're declining. And then this 20-period simple moving average study is extreme positive. Not necessarily doom and gloom, but we could see things slow down. When you pair that up with the slowdown that we're seeing in the ADX, we might be in for kind of a sideways week. All right, positive signs. Still have things looking quite positive. The 10-day equity put call chart is still going down. There are some concerns here. Accumulation distribution, you could say it's rather extreme based on the boom indicator. We did decline a little bit with the Chaikin money flow. Not usually a good sign, but still, when we look at the moving average, it's still going up. And the Chaikin oscillator, this is kind of the bigger warning sign that I've been following for a few days now. It's been declining even as we had that solid update on Friday. The advanced decline lines, though, are still looking really good. The S&P and NYSE McClellan oscillators and summation indexes are positive. The Swenlin trading oscillator, it's positive, but declining. And it's yellow because it's in between a primary and secondary indicator. The parabolic SAR, and then over the weekend, if you watch the weekly video, the weekly chart clicked back over to positive as well. Our oscillators are positive. Looking at the bullish percent indexes for the S&P, NASDAQ 100, and NYSE, they are all positive. The ease of movement is positive, even though it declined. The money flow is extreme positive. The ultimate oscillator has been declining now, but it's still positive. The Copic curve is positive, the vortex, and we're a little bit concerned about that red line getting a little too far down as an extreme negative reading. And the financial sector is still positive, and the momentum for the NASDAQ 100. So our conclusion, we're positive, but we still are overbought, and we're on a pace to keep up with being below average with volume. On a short term, we're positive, but overbought, possibly extreme positive. Again, that goes back to that 20-day moving average study. We're also overbought, but remain positive in the intermediate term. The long term is positive, but our 150 and 200 moving averages are looking a little extreme. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.